Imagine waking up to a world where over $221 billion simply disappeared from the global crypto market overnight. That's not a hypothetical. This is what happened when Israel confirmed it had struck Iran, prompting Tehran to label the move an outright declaration of war. In the blink of an eye, the world's riskiest financial playground turned even more treacherous. Stock markets worldwide trembled in unison. Oil prices surged by nearly 7%, adding to the unease. Investors from New York to Tokyo held their breath, watching as the digital assets they once called a safe haven plummeted. The big question on everyone's mind, is crypto really the new gold, or is it just another high-risk bet waiting to backfire the next time the world shakes? To answer that, we need to unravel the tangled web connecting crypto to the rest of the global financial system, a web that's grown denser with every passing year. A decade ago, cryptocurrencies were outliers, barely noticed by Wall Street and largely immune to the shockwaves of geopolitics. Bitcoin was a curiosity, Ethereum was an experiment, and terms like DeFi and NFTs were not even on the radar. Back then, a missile strike in the Middle East might have sent oil prices soaring, but Bitcoin and its cousins would have barely flinched. Those days are long gone. Fast forward to today, and a single missile can set off a domino effect across every corner of the financial world. When news broke of Israel's strike on Iran, Bitcoin tumbled by over 4% in a matter of hours. Gold, the time-tested hedge, rose by 1%, living up to its reputation as a sanctuary in times of crisis. The S&P 500, long considered a bellwether for global economic health, slipped below 6,000, signaling widespread anxiety. But the biggest surprise? Crypto, once heralded as a decentralized alternative, is now moving in lockstep with traditional risk assets. The myth of crypto as an uncorrelated safe haven has been shattered. As Caroline Moron of Orbit Markets put it, crypto is reacting negatively to news of Israel strikes in Iran, in line with major risk assets. In other words, when the world gets jittery, so does crypto. This isn't just about headlines or knee-jerk reactions. The underlying structure of the crypto market has changed dramatically. The rise of decentralized finance, DeFi, has introduced new layers of complexity and risk. Non-fungible tokens, or NFTs, have attracted waves of speculative money, fueling bubbles that burst as quickly as they form. Stablecoins, which once promised to anchor the market with their supposed dollar backing, now sway in the unpredictable winds of regulatory threats and global events. Central bank digital currencies, or CBDCs, are on the horizon, bringing with them new forms of government oversight and competition. Let's zoom in on the numbers. On the day of the Israel-Iran escalation, the global cryptocurrency market cap plunged by 3.46%, wiping out $221 billion. Oil prices surged by nearly 7% as energy traders braced for supply disruptions. Bitcoin, the king of crypto, fell more than 4%, while gold ticked up by 1%. The S&P 500 dipped below 6,000. The message was clear: no asset class is truly immune to global chaos. But here's where it gets really interesting. Not all cryptocurrencies are suffering equally in this storm. Some are even showing surprising resilience, or at least the potential for a quick rebound. Let's take a closer look at 3 altcoins that have caught analysts' attention: Hyperliquid, SPX 6900, and Immutable. First up is Hyperliquid, known by its ticker HYPE. Despite the carnage elsewhere, HYPE has managed to hold its ground. As of June 13, 2025, its trading volume stood at a robust $165.04 million. It recently achieved a new all-time high and is now just 9% away from surpassing that record again. Technical indicators like the MACD are flashing bullish signals, suggesting that HYPE could bounce off its support level and make another run for the top. But the flip side is just as dramatic. If investors lose faith and start selling, HYPE's price could cascade down through multiple support levels, potentially dropping to $31.26. In crypto, fortunes are made and lost in days, sometimes hours. Next is SPX 6900, a token that's seen its own wild ride. It fell by more than 15% in just 24 hours, landing at $1.36. This was after narrowly missing its all-time high of $1.77. The Relative Strength Index, or RSI, had recently entered overbought territory after a staggering 50% rally, hinting that a correction was overdue. Now, as the RSI returns to more comfortable levels, analysts see the possibility of a renewed bullish surge if broader market momentum cooperates. On the other hand, if sentiment sours, SPX could plunge through its support at $1.20, possibly tumbling to 98 cents or lower. As of June 13, 2025, SPX holds an impressive rank of 84 on CoinMarketCap, with a market cap of $872.91 million. Then there's Immutable, or IMX, which has been moving against the grain. After a 15% decline in the last 24 hours, IMX now sits 21% away from reaching its all-time low of 34 cents. For investors, this is a knife's edge moment. If IMX manages to attract fresh demand, or if the broader market recovers, it could stage a dramatic comeback, as it did the last time it brushed against oversold territory, when the RSI triggered a reversal and sparked a sharp price increase. However, without a turn in sentiment or new buyers stepping in, IMX risks slipping below its support at 39 cents, possibly setting a painful new all-time low. The story of IMX is a microcosm of the entire altcoin market: high risk, high reward, and no guarantees. Let's not forget the big picture. The current crisis has exposed just how closely crypto is now intertwined with traditional finance. According to the latest research, Bitcoin's dominance over the crypto market hovers around 51.48% as of mid-June 2025. That means even as thousands of altcoins compete for attention, the fate of the entire sector still depends on the performance of a handful of major players. When Bitcoin sneezes, the rest of the market catches a cold. Against this backdrop, the Fear and Greed Index, a popular measure of market sentiment, flashes a warning. As of June 13th, it sits at 70, deep in greed territory, even as prices tumble. This paradox speaks volumes about investor psychology. In crypto, hope and fear can coexist, driving wild swings in both directions. Expert views reflect the complexity of the moment. Caroline Moron of Orbit Markets highlights the alignment between crypto and other risk assets. David Oxley of Capital Economics warns that a $10 rise in oil prices could add about 7 pence to the price at the pump, squeezing consumers already worried about inflation. Richard Bronze of Energy Aspects calls the situation very significant and concerning, while Mohammed El Arian of Allianz notes, it has the potential to be a bad shock for the global economy at a bad time. Even former President Trump weighed in, claiming that Israel's actions could be great for the market because, in his view, Iran will not have a nuclear weapon. But what does all this mean for investors? The answer is far from simple. Benjamin Cowan, a leading crypto analyst, warns that altcoin volatility is only going to get worse as geopolitical risks pile up. Michael Van de Poppy, another respected voice, believes that altcoins could surge if Bitcoin stabilizes above $70,000, a level not far from its historical highs. Altcoin Daily emphasizes the importance of strong fundamentals, urging investors to focus on development teams and real-world use cases. Let's explore some possible scenarios. If the Israel-Iran conflict escalates further, we could see another wave of panic selling across all risk assets, including crypto. Investors might flee to traditional safe havens like gold or even cash, leaving the most speculative tokens out in the cold. Bitcoin, with its established reputation, might fare slightly better, but even it is not immune to sudden shocks. At the same time, heightened regulatory scrutiny could follow, as governments seek to clamp down on potential sources of instability. On the other hand, if tensions subside and a period of relative calm returns, analysts are forecasting the possibility of an alt season, a time when smaller, riskier tokens outperform Bitcoin and attract speculative capital. This phase is often marked by rapid gains, but also extreme volatility. Michael Van de Poppy says, altcoins will surge if Bitcoin stabilizes above 70,000. But make no mistake, the casino-like nature of the altcoin market, fueled by DeFi, NFTs, and endless innovation, means that new opportunities and new risks are constantly emerging. The rise of Layer 2 solutions, such as Immutable X, is helping to scale Ethereum and improve efficiency, but also introduces fresh technical and security challenges. Stablecoins and central bank digital currencies could reshape the entire landscape, offering both stability and new forms of regulation. The regulatory picture is evolving rapidly. Policymakers in the United States, Europe, and Asia are racing to catch up with the pace of innovation. Clear rules could attract institutional money, bringing much-needed stability and legitimacy to the space. But regulation will also mean the end of many of the so-called Wild West opportunities that attracted early adopters. The coming months will test both investors and developers, separating serious projects from hype-driven experiments. So, what should you do in this environment? Here are some practical steps. First, recognize that crypto is no longer insulated from global shocks. You need to watch more than just crypto news. You must pay attention to geopolitics, global economic trends, and regulatory developments. Diversification has never been more important. As Invest Answers advises, don't keep all your capital in a single project or asset class. Spread your bets and avoid putting all your eggs in one basket. Second, focus on fundamentals. Hype can pump a coin for a day, but only strong development teams, active communities, and real-world use cases will survive the next crisis. Do your own research. Check the technology, study the team, and scrutinize the project's roadmap. As Altcoin Daily puts it, strong development teams and real-world use cases separate winners from losers. Third, beware of emotional trading. The Fear and Greed Index may be flashing greed, but that doesn't mean the market can't tumble further. FOMO, fear of missing out, and panic selling have destroyed more portfolios than any missile strike. Remind yourself that markets recover, but reckless decisions can leave lasting damage. Develop a plan, set clear stop losses, and stick to your strategy. Fourth, stay informed about regulation. The landscape is shifting quickly. New rules could open the door for institutional investors, but they will also raise the bar for compliance and transparency. If you want to ride the next wave, you need to understand what's coming and be ready to adapt. The future belongs to those who can spot real innovation amid the noise. Finally, maintain perspective. Volatility is the price of admission in crypto, but it is also the source of its greatest opportunities. As Raoul Pal, CEO of Real Vision, says, crypto can be a hedge against traditional risks if you know what you are doing. Don't treat crypto as a lottery ticket. Moments of crisis often create the best entry points for patient, informed investors. Let's step back and look at the broader historical context. This is not the first time global events have rattled financial markets. In the past, wars, oil embargoes, and political shocks have sent stocks and commodities into tailspins. What's different now is the speed and interconnectedness of the digital age. A single tweet, a sudden escalation, or a regulatory announcement can wipe out billions in minutes. The lines separating old and new finance are blurring every day. Take, for example, the COVID-19 pandemic in 2020. In those early days, both crypto and stock markets crashed as uncertainty gripped the world. But as central banks unleashed unprecedented stimulus, Bitcoin and other digital assets staged a remarkable comeback, outperforming many traditional assets. In the following years, the rise of DeFi, the NFT boom, and the entrance of institutional investors pushed crypto into the financial mainstream. Today, a growing number of pension funds, hedge funds, and even governments are experimenting with blockchain and digital assets. Yet, the same forces that brought crypto into the spotlight have also made it more vulnerable. The Israel-Iran conflict is a stark reminder that no market operates in a vacuum. Every asset is now connected, either directly or through the psychology of investors. When fear spreads, it spreads everywhere. So, is crypto an opportunity or a trap as geopolitical risks rise? The truth is, it is both. For those who approach it as a get-rich-quick scheme, the dangers have never been higher. But for those who take the time to learn, research, and plan, moments of crisis often present the greatest opportunities. As Raoul Pal puts it, crypto can be a hedge against traditional risks, if you know what you are doing. Here's a secret the mainstream media rarely mentions. Behind every crypto crash triggered by global events, there is an invisible handshake between Wall Street and blockchain. When you hear about billions wiped out in hours, remember that somewhere, institutional giants and sharp retail investors are quietly positioning for the next bull run. The lines between old and new finance are merging, and the next chapter will be written by those who adapt fastest. In summary, the idea of crypto as an untouchable safe haven is a myth. The market's reaction to the Israel-Iran conflict has exposed its vulnerabilities and erased any illusion of immunity. But within this chaos lies opportunity. The future will be shaped by those who pay attention, diversify wisely, focus on fundamentals, and adapt to a rapidly evolving regulatory landscape. Whether you're bullish or bearish, the only certainty is that change is coming fast. If you found this deep dive helpful, don't forget to hit the like button, subscribe, and ring the bell for more expert insights on how global economics and technology are shaping your financial future. Let us know in the comments, Are you feeling bullish or bearish on crypto during these turbulent